Ladies and gentlemen, good day and welcome to the Q3 FY22 earnings conference call of Greenply Industries Limited, hosted by Asian Markets Securities Limited. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Karan Bhatelia from Asian Markets Securities Limited. Thank you, and over to you, sir.
Good morning, everyone. And on behalf of Asian Market Securities, we thank you all for joining us onto the Greenply Industries 3Q and 9-month FY22 conference call. In the panel today, we have Mr. Manoj Tulsian, Joint Managing Director and CEO, Mr. Sanidhya Mittal, Joint Managing Director, and Mr. Gautam Jain, AVP Strategy and Investor Relations. Before we begin, I would like to state that some of the statements made in today's discussion may be forward-looking in nature and may involve risk and uncertainties. A detailed statement in this regard is available in the recent presentation that was sent to you by the company earlier. May I now invite Mr. Manoj, sir, to begin the proceedings of the call. Thank you, and over to you, sir.
Thank you, Karan. Very warm welcome to everyone present, and thank you very much for joining us today to discuss Greenply's operating and financial performance for Q3 FY2022. Before proceeding, I would like to welcome Mr. Nitin Kalani, who has joined us as CFO and is also attending this call. To start with, let me share some insights on our financial performance in the current quarter. I am pleased to inform you all that as per our previous guidance of sustaining the revenue growth momentum of Q2 FY22, we have achieved consolidated sales of rupees 421 crores, a growth of 23.7% on YOY basis, and standalone sales of rupees 373 crores, a growth of 20.3% on YOY basis. On the margin front, we face challenges. Our Q3 FY22 consolidated adjusted core EBITDA margins declined by 130 basis points on trailing basis to 10.9%. This happened due to the undermentioned factors. First, a steep hike in both the key raw material prices, timber and chemicals. Although we have taken reasonable price hikes during the last quarter, but it was not sufficient to cover the increase in raw material prices. In order to maintain our profitability, we have already taken next round of price hikes of almost 2.5% during this month. Secondly, our sales mix has changed as our own manufacturing contribution has reduced to 62% in Q3 from 65% in Q2 FY22. And the revenue share of manufacturing partners and trading revenue has increased. Going forward, our manufacturing is likely to increase once again as our new Greenfield project at Sandila, Lucknow starts production, which is expected to happen anytime in Q1 FY23. To put things in perspective, these margins exclude non-cash cost of ESOPs of around rupees 3 crore in this quarter. On consolidated basis, working capital days have slightly gone up from 39 days in September 2021 to 42 days in December 2021. Going forward, all efforts are directed to keep that in check. In our Gabon business, we have achieved sales of 48 crores in the last quarter, a growth of 58% on YOY basis and a decline of 14.5% on QOQ basis. The logistics issues that still prevail are affecting the productivity, hence impacting the margins. From demand and realization perspective, we expect it to be positive for next year, driven by strong demand from European and South Asian FTA markets. From macro perspective, we maintain our optimism on the wood panel industry in the backdrop of solid fundamentals of our economy and the promising outlook of the housing sector. With number of factors like low interest rate, falling house prices and state government stimulus supporting the housing market revival, we are witnessing tremendous growth numbers in home sales. Although commercial real estate is yet to pick up, we expect the trend in housing segment to continue over the long run. Adding to our outlook, we applaud government's decision to allocate rupees 48,000 crore under the PMAY, Pradhan Mantri Awas Yojana, in recent Union Budget for 22-23. As the company prepares to new level of horizons by expanding the capacities as well as entering into new lines of business, we are working vigorously enhancing the management bandwidth across the functions directed towards long-term growth plan. In addition to building team, We have also strengthened our processes and systems to improve our business metrics. To name a few, we have already done a lot of IT projects implementation and many more to be rolled out soon, which are directed towards process and turnaround time improvement, etc. We have implemented very strong commercial decision policies and protocols directed towards credit controls, inventory management, better realizations, and gaining market share. We firmly believe this would be a critical key success factor in our future growth. With many more such initiatives, now we have very clear strategic roadmap for next few years. With this statement, I would like to hand over to Sanidhya to update on our new projects and manufacturing partners.
Thank you, Manojji, and good morning to everyone on the call. I am glad to announce that we are on fast track mode in implementing our new projects. In our Greenfield plywood manufacturing unit at Sandila, Lucknow, the plant's machinery erection work is underway. Trial runs are expected in March 22 and commercial operations will commence in Q1 FY23. All the capex has been done and no further investment is to be made in this unit. In our new MDF plant in Vadodara, Gujarat, all plant and machinery have been ordered and construction activities are going on under full swing. The project should achieve COD by Q4 of next year. In our asset-light model, we have two manufacturing partners for manufacturing of plywood and allied products. The first project had started production of plywood during last year and now we are fully utilizing the capacity. The second project has started partial production in the last quarter and balance will start in Q1 FY23. Further, we have signed up another manufacturing partner for manufacturing of plywood and allied products in Hapur, UP. The unit will have capacity of 7.5 million square meters per annum. The plant should be operational by Q4 FY23. Talking of the plywood industry scenario, the industry is moving towards a steady growth path with organized sector growing at the cost of unorganized players in the market. Owing to consumer affinity for durable and branded products and working capital constraints among the unorganized player, the market share is shifting from unorganized to organized. Also, with some organized players in related industry entering into the plywood segment, the industry will expand and more faster towards organized segment. Hence, we take this as a welcome step. With this perspective, I would like to open the floor for Q&A session.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Anyone who would like to ask a question, please press star and 1 at this time. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Achal Lohade from JM Financial. Please go ahead.
Yeah, good morning. Thank you for the opportunity. My first question was in terms of the volume growth. If you look at, we tend to see relatively we have been doing a little lower number in terms of growth. So I just wanted to understand, in terms of the industry, I know it's hard to say, but what is the industry growth in last, say, 9 months? Was that a sharp decline or was that a positive growth? And what kind of market share gain have we seen?
So, Akshat, you only answered your question. It's very hard to say what type of volume growth the industry has gone through. As I always keep maintaining that, we struggle to get such type of data. But I would say, how we are looking at things is for growth within the industry. And I keep maintaining what I have said earlier also that, there's so much of opportunity for organized players during this period when there are supports in terms of, housing sector doing well and market share moving from unorganized to organized. So I think what we are looking at is the growth within the industry. And that is what we are trying to target also clearly.
Right. In terms of the expectation, how do we look at, you said, in your opening remarks, the sales momentum has picked up for real estate, residential has picked up, commercial is yet to. If I were to ask you from next 3-year perspective, what kind of growth can we look at for us, specifically given the manufacturing, the JV, and also the distribution part? How do we look at the growth?
See, if I say from the industry perspective, first thing, I'm very bullish that, yes, this year, if you see the numbers, I was looking at a lot of numbers also we keep tracking. So on the real estate side, on the house, we have almost reached to now FY19 level, and looks like that, now we will start crossing those numbers going forward next year. On the commercial space side, we still find that there is a lag. But there are certain pockets in the country which is still doing better than the other pockets. And I am sure that will bounce back because, my own feeling is the way today, after the pandemic, things have changed, where now both the things are getting equally promoted, the work from home concept as well as work from office, which means you need more space. So be it the home side, be it the office side, I have also been interacting with certain MNC players who have been saying that, the same office space earlier, if they were occupying at, let's say, 100 square feet per person, now it will be maybe 150 square feet per person. So what they have done is they have created some spacing, which means that the office space doesn't come down, but the number of people sitting that in that office comes down. Which means again that there would be certain amount of number of people whom they would be allowing to work from home. And then in work from home again, if there is a 2 BHK home, people need to make it 3 BHK because you need that space, a separate office space. And there are certain data, and I was talking to a few more consulting houses who said they have started giving all type of allowances also for setting up office at home. So with these type of things, I think the industry momentum should be very strong. Now, adding to the same, interest rates, if you really look at today, this is the minimalistic rates which we are today looking at. Yes, we talk about inflation, we talk about maybe interest rates slightly going up also, but still I feel that in the next 2-3 years, the interest rates for housing will still be sub 7.5 or 8 max, which will still be a very good rate for consumers who really wants to buy new house for themselves. So looking at these things, I think there is quite a bit of opportunity from the external side. Also adding to the same, the shift from unorganized to organized. And within the company, for sure, yes, looking at expansion of capacity. So while we are talking, the Sandila plant will be operational in Q1. And even the earlier 2 JVs which we had signed, 50% of facility in one of the JVs will become operational. And now we have done another tie-up in Hapu. So that facility will become operational sometimes in Q3. So we are totally geared up, in terms of dealing with the volume growth also. And to add to that further, I would say that as an organization, we are targeting at least 5 to 7% volume growth going forward with the type of efforts what we are taking. Though I am not assuming the industry to grow, I am just assuming that we will be able to grow within the industry.
If I hear you correctly, you're saying you're bullish on the industry prospects, but you're not looking at or assuming any industry growth, but you will grow at 5 to 7%.
Yes, 5 to 7% of volume growth.
Yes, volume growth.
Yes.
Okay. And my second question was, you have taken 2.5% price hike in the fourth quarter. Does that cover your, entire RM cost inflation? If you could quantify, each of the components of RM, how much has been the cost escalation in last, say, 9 months or 12 months on a YY basis?
No, I won't be able to share because that will be too detailed. What I can give you a perspective is 2 things. One, the recent price increase what we have taken was to cover my cost differences which we could see up to December. But while we are talking, the prices are still not stable. So there are some chemical prices which is again started moving up, and there is timber prices also which is slightly high in January. So I don't know, maybe we might have to look at another price increase in quarter 1 again. It's an extremely volatile situation, the way we have looked at in the last 12 months. And though we try to cover up all the increase, but somehow there is always a lag. The raw material prices are moving faster than what we assume. So we wait and see.
But I would imagine, sir, the cost inflation will be much higher for the unorganized. So what kind of price difference have we seen, say a year back between us and them, and now? Has that narrowed meaningfully?
Yes, our own perspective and some test checks says that the gap would have reduced by maybe 2 to 3% from the earlier time a year back to now.
Would you be able to quantify what was it earlier and what is it now?
No, so the difference, where the industry was operating was around 10% or 11%, and I think maybe now it is around 8 to 8.5% type.
Okay, understood. Thanks. And just last one clarification in terms of the margin guidance. Earlier you were talking about 13 to 14% margin guidance for the next couple of years. Would you stick to that, or is there any change in that?
Well, Akshat, I'll tell you, we had taken a lot of initiatives, and I was quite confident that maybe I had given a 2-year to 2.5-year perspective, and I felt that we would be able to do it much before that. But because of this unprecedented, raw material price volatility, even supply chain volatility, which is there, we have been just chasing those the raw material cost increases, and because of that, some of the margins which we could have achieved has not been achieved. But for sure, I am still confident that margins will improve even further. Once the raw material prices are much more stable, I would be able to give you better direction and clarity. The other thing which we are also looking at, which we have maintained earlier also, is to see in this business that how we are able to improve the ROE. So that is another number to track going forward for Greenply as a company when it comes to plywood business.
Got it. Thank you. I'll come back in the queue for further questions.
Okay, thank you.
Thank you. The next question is from the line of Sneha Talreja from Edelweiss Securities. Please go ahead.
Good morning, sir, and thanks a lot for the opportunity. So firstly, I just needed some clarity on the previous participant's question, wherein you said that you're targeting 5 to 7% volume growth. Is it for a specific duration that you're mentioning, like like Q4, or is it for FY23? I just wanted some clarity on that particular guidance that you gave.
No. So I'm saying, I'm talking of next year, because I personally see a lot of opportunity to grow within the industry. And that's where we are looking at that, irrespective. So if there is industry growth, it happens, that number will get added. But this is a number which, in a way, I'm trying to say that we will gain market share. Okay, and that market share mostly will come from the unorganized sector. That's what we are targeting.
So this is over and above what the normal growth rate you will be seeing, plus 5 to 7% on account of unorganized, shift from unorganized to organized.
Yeah. So if the industry grows, of course, we are a major participant in the same, right? But I'm saying that what we are trying to internally see, rather than getting into that debate, that how do we improve our market share. So a 5 to 7% volume increase also for us is not difficult. If we do a few good things in the right perspective, that is something which is achievable. Over and above that, if the industry grows by another 3-4%, then for sure, that number adds up.
Okay. The reason I was asking this is, if I look at any other peers in the building material space, whether it be, peers in the wood panel space itself or even any other space, everyone, given the low base of what you've seen for this year or last year, is guiding for double-digit volume growth. So 5 to 7% growth for your company actually looks relatively very low. So just wanted to ask the reason for being so conservative here.
No, this is gaining market share. So I am not even talking about, because those are very assuming statements. If the industry grows at 8%, then my number becomes 8 plus 5 or 8 plus 7, maybe 14% volume growth. Okay. So I'm sure others might be talking of just the overall growth, whereas I am talking of gaining market share. And this market share, as I'm clearly saying, we are targeting is from the unorganized segment, because we see a lot of opportunity there.
Got that. And secondly, I just wanted some clarity on your margins. So this quarter, you gave a couple of reasons that your outsourcing percentage has increased, because of which margins have come off. That's one reason. And secondly, raw materials. I understand the raw material will cool off at certain point of time, but if your mix keeps changing towards the share, towards the JV or the procurement that you're doing through outsourcing, what are the ways you will be able to inch up those margins to the earlier guidance of 14% or 15% eventually? What are the levers for that?
So, it's a very interesting thing what you are talking. We are also doing some work on this. We will have even more clarity in a couple of months. But I will give you the perspective. One, the Sandila plant. Once this becomes operational, this plant is going to cater to, the premium segment. Right? So that helps us in improving my margins. Second, we have also been learning a few things. We started with our first 2 manufacturing partner concept. Okay, there we had certain amount of learnings. So we are doing some course corrections where we made certain mistakes. And I think that will help us, or that has helped us in better drafting and understanding of these future manufacturing partner contracts which we are signing. So that will help us in improving our margins further on that platform also. But given a scenario, if your value segment continues to grow faster than this, then yes, we will again have to debate this, and we have to see that what needs to be done. But right now, I think margins can improve further, because once the premium segment production becomes up and running, we will again gain back on the margins.
Sure, but in the near term, can we expect margins to hover somewhere about here, or maybe marginally up with raw material prices cooling, or you passing it on?
I still feel for sure we would be able to maintain this margin, and the only chance is to grow from here in terms of margins.
So we can say the bottom is at least achieved.
Sorry?
So at least the bottom is achieved. We will not go below this level until there is another steep price increase.
No, because see, we are not doing anything per se where we get a confidence that it will further come down. Whenever there is a raw material increase, we are trying to pass it on. The only challenge is that there is always a lag. And unfortunately, in the last 1 year, we have only seen the prices going up. It slightly cooled down in the month of December, and we were optimistic that okay, now possibly it is stable and it will come down. But again in January and January end, we are seeing that again suddenly it has gone up. So the market is very uncertain. So you will always see a lag of maybe 1 quarter, but there is nothing per se which will bring down the margin further. Okay, there are certain improvements also which we have done, and I am very hopeful that the margins get stabilized at these numbers, or it can improve further. Even on the console the numbers, if you are talking. On Gabon also, you will see the margins are minimalistic. So there also we are only hoping that we are at the worst end of the cycle. Only things can improve from there. There cannot be anything worse than that.
Understood. In fact, once you were speaking of Gabon, any clarity on the container availability and all those trade issues? Are they eased up? Are we now able to cater to those orders which we were kind of pushing, or we were not taking those orders and not catering to certain markets? Have those concerns eased now?
Yeah, good that I mentioned all these things around a year back. And we still face almost all the challenges what you said. So It's a difficult environment, but good that we are at least surviving. We are still able to do a level of business where we are still in profit. But as I said, that these type of opportunities only makes the company stronger, because then we keep looking at options where we can further be efficient, and we can further be further improve on productivity aspects. So a lot of things has been done. So I think once the cycle rebounds, maybe we can surprise the market, but I will not put any timelines, because I still feel that even next 2 to 3 quarters, things on the supply chain side and this may remain very similar to what it is right now.
Got that, sir. So one last one, if at all I can just ask. You mentioned a lot in your opening remark with respect to the structural changes that you're making, whether it be regards to the credit policy, the pricing, gaining market share. Are those changes done with? Credit policy, we pretty much said the last quarter also we are done with. Good part is we've still seen some improvement. My idea was if those structural changes are done with, can we? When can we start expecting the growth now if those structural changes are done with? And also the similar set of things is we've seen a lot of changes with your employee set, also senior management changes, head changes. Are those changes all with, or are you expecting some more changes to be done in the coming future? Some clarity there would be helpful. Thank you, sir.
Well, I think your first question was on
the market side, with respect to credit policy, the discounting policy, pricing, the one that you're doing with your distributor change, are those structural changes done with? And some of the other changes which I spoke about were related to your employee changes or maybe the IT things that you're doing in the company. Are those changes done with? Or is it a continuous process?
So Sneha, if you see last year Q3, FY21 also, okay, we had done a decent job and we had done, as I said, if I recall, at that point of time also I would have mentioned that most of the corrections were done, but something was still left to be done in Q4 of last year. So if you see on growth, we are almost grown at 20% compared to last year Q3. Okay, and knowing that the market may not have grown, the numbers are good. Now, those basic changes and everything has been done, but as you get into and you have more insights, you have more opportunities to do things. So I would always say that it is a continuous process. The basics have all got corrected. Okay, there is no differences now. We are just building up now. We could not have built up last year when we were just doing it. And try and understand that's a big change what we have brought in. Not only for the external environment, but even for the internal environment. Because when a company operates in a particular manner and we want to change things, okay, the internal acceptability itself is also not easy. So we have gone through all those. Now that is all past, and improvements are always possible. We'll continue to do that. And I think the growth will continue to happen now. No more because of these type of things, it is going to hamper my growth. It's given now in the market, it's given now to the team that this is the new way of working, and everyone actually is very, very happy. The feedback today is that both the internal team as well as the external team are extremely happy with the changes what we have done. It was painful, but it is over and everyone is happy. And what was your question? Next question?
I think more or less done. I think we were just asking about employee-related changes also. Are those mostly done?
Employee-related changes it's a continuous process. That will continue to happen as and when and where we need that. Yes, changes needs to be done. We are a growing organization. We are adding new verticals, new segments, right? So we have a lot of space also for accommodating the existing team also and also adding new talent. It's a continuous process. It will continue to happen even for the next 2 years.
Sure. Understood. Thanks a lot, sir, and all the very best.
Thank you.
Thank you. Ladies and gentlemen, we would request you to limit your question to 2 at a time. Should you have a follow-up question, please rejoin the queue. Thank you. The next question is from the line of Venkat Samala from Tata Asset Management. Please go ahead.
Hi, sir. Thanks a lot for the opportunity. Sir, my question is just, you've partly answered this before as well, but I just wanted to understand when you mention 5 to 7% kind of volume growth from market share gain, how does this tie in with the double-digit volume growth that we have spoken about entering into, FY23? Has anything changed there?
Well, as I said that, this 5 to 7% volume growth which we are looking at is basically market share gain. Okay. And this gets topped up with whatever industry gain what will happen. Okay. So even if earlier only we have discussed that industry is growing at 3 to 4%. So even if it is 3 to 4%, we will be in double digits. But the fact of the matter, if you really look at in the past, there were 3-4 years when we have not registered any volume growth. So this hopes and expectations have come because we have corrected many things, as I just mentioned in the last query. And the team itself is very bullish. That has opened up a lot of new avenues for us to look at, which in the past sometimes we were not able to look at the opportunities. Okay. So, it's all about how my team is behaving today. So the momentum in the team is very bullish, and we are able to do the right things together. So it's a number, it can be even better than this, but I have just put a perspective.
Understood. So the optimism that we had maybe Q2, Q3, that kind of still continues, right? I mean, there's no change to that.
Oh, no, absolutely.
Okay. Understood. And maybe a near-term question. Generally, we have witnessed seasonality being favorable to us, Q4 versus Q3, right? And this again in the context is that, we are now behind the pace when we were enjoying the lower base, right? So now Q4 FY21 onwards, the high base would also be sort of kicking in, right? So in that context, how do we see Q4 of FY22 pan out now?
No, I mean, I don't buy this argument of a high base or something. I just look at what is the opportunity today in the market. And as a team, we feel that there is a lot more what we can do. And that's why, I didn't even commented or I didn't even said that if the industry grows, then I will grow. If the industry doesn't grow, I will not grow. When there's so much of opportunity to grow, we must look within ourselves and see, which are those pockets and corners where we can grow. See, of course, we have to also keep in mind that we had certain limitations in terms of even the volume increase. Okay, and that's where these new capacities are also getting added. So that eases out the pressure because we deal in within the panel also we deal in some multiple product lines. So sometimes it happens that you have production constraint for a particular product category, and there is a mismatch in terms of order versus the supply side. So as and when these things are also getting corrected, I hope that possibly we are missing out something, maybe a 1%, 1.5% growth also because of those mismatches, which we are trying to figure out, trying to correct through adding capacities. All those things happen, then definitely these numbers will improve only. So the question of base doesn't come into play. We have a long journey to play. If this point of time we start talking about a large base and all those, then so we are actually doomed.
Right. My question was just that the usual seasonality wherein Q4 is stronger than Q3, that will still that will still play out in this quarter also, right? There's no change to that.
Yeah. I don't see a big change nowadays. If you will see, how our stack up is, it's not a big change, but yes, normally Q4 is slightly better than Q3.
Understood. And one last question is, how do we look at this ESOP cost quarterly run rate? I mean, I'm not just talking about maybe Q4, but maybe running into FY23 or FY24 as well. How should we look at it? Should we look at it as an absolute number or as a percentage of revenue? I mean, any color on that would be helpful.
ESOP cost, first of all, it is a non-cash cost. Okay, so we have separated that out because when we compare any quarter, period to period, then it doesn't give us the right comparison. It's a non-cash cost. Second, the ESOP cost would be higher for the next 2 years, and then it will taper down. So maybe you can assume around 1% of sales or 1.2% of sales for next 2 years, and then it tapers down quite a bit. But in any case, we have started reporting it separately, our adjusted core EBITDA. So that is the number what we should focus at. Yes.
Understood. And one last question, sir. This MDF, whatever capex that we were kind of envisaging for the MDF plant, with the increase in commodity prices, is there any change to that cost, or is that largely built in? I mean, that contingency.
No, see, contingency we had actually taken initially very tight costs. We're still doing our work, but as we say, there is a chance that maybe it may slightly go up. Commodity prices are crazy. It's just crazy. And we are still trying to do everything. We are trying to time it also at times, but this is something which, other than God, nobody can time it better. So when we try to time it, we go wrong again, right? So, and over and above that, today the logistics challenges, the sea freights have gone up significantly. Every cost have gone up. And over and above that, the uncertainty. So, it would be a great job, I can tell you, if we are able to do it within 550, 555. Looks, it will cross that number, but we are still trying to see whether we can contain it within that number.
Understood. Sure. And if at all it exceeds, would it be within 5-10%?
Yes, it should not go beyond that. We are really working very hard, and we have also tried to squeeze the project implementation timeline. So we are trying to save through that opportunity also. So within 5 to 10%, yes, for sure we will be able to manage this.
Understood. Thank you. Thanks a lot, and wish you all the best.
Thank you.
Thank you. We would request participants to limit your question to 2 at a time. The next question is from the line of Abhishek Ghosh from DSP Mutual Fund. Please go ahead.
Yeah, hi sir. Thank you so much for the opportunity. So just a couple of observations. Yeah. If I look at your ad spend, that's kind of come down as a percentage of sales. That's just about 2.5%. If I look at prior periods, it used to be higher. At the same time, if I look at your distribution network, over the last 1.5 years, that's seen quite a bit of fillip, particularly into the rural and urban. So how should we look at it if I just look at your, broadly the distribution, you've strengthened a lot, but ad spend has come down. But at the same time, you've also rationalized your working capital days now. So if you can just broadly help us understand along these 2-3 aspects.
No, Abhishek, when we look at numbers on a quarter-to-quarter basis, sometimes these perspectives do come up. But our ad spend, like in Q4, is very high. We have another TVC which is going on during this quarter. So by the quarter end and year end, we will be back to that 3.5% numbers. Okay, so you will see that increase in cost during this quarter, which will get booked. So as a company, we are not bringing down our ad spend, overall marketing spend below 3%. We continue to look at investing on that front. And, so on marketing also, we have a rejuvenated team. We have a new marketing head who has joined, is looking at things again from a different perspective. And we are planning many things for next year. But as far as those, total budgetary cost would be there, we will not exceed more than 3% even for next year. That's how I look at this point of time. And which will be good enough for us to give us a better, larger visibility with the sales growth number, with that percentage remaining the same. So we'll continue to spend on the brand side. There's no cutting corners there.
Sure. And so the dealer addition that one has seen in the rural and semi-urban, it's almost doubled in last 1 year. How should one look at that? Any benefits of that? Are you already starting to see, or just some thoughts there?
No, so we have got certain benefits from this increasing dealer base. But at the same time, we are doing other works also. We are doing a lot of work on the secondary side also, not only on the primary side. So we are working on the depth and distribution. We are also working on demand generation. And we are actually learned a lot also from going into rural, because there were a lot of supply chain issues and other things which we faced as a hurdle. In terms of what we were assuming will work versus what actually the market was expecting us to do. So there are some course corrections which we have started doing. So certain portion of that dealer network which we created, but it stopped, or I would say it started giving us negligible yield, will again come back into the process. So I think, next year again we'll get traction, because we've done some course correction on the logistics side, and we are continuously working on it. So that is going to help us only, as we enrich our depth and distribution, it is going to enrich overall numbers. So when I'm talking of improving market share, it is because there is a lot of work which is happening on the ground level. It will be very unfortunate with so much of effort what we are putting. If we don't get those numbers, then possibly again we have to sit on the drawing board and look at where we are making mistakes again.
Okay. And so just two small ones is that what will be a peak debt when your MDF plant gets commissioned next year? What will be the peak debt that you're likely to be at?
You're talking of the consolidated debt, right?
Yeah, I'm referring to the consolidated.
So I think on a debt equity basis, we should be slightly less than 1. And on an absolute number, it can go up to around 600, 620 odd crores.
Okay. And just one last question. You've mentioned that the plywood, this way you're incurring a capex of 113 odd crores. The revenue potential is 250 crores per annum, which is getting commissioned in 3-4 months' time. When do you expect to realize this revenue of 250 crores? Is it going to be a 2-year journey or is it going to be a more like 3-4 year? Any thoughts?
No. By H2 of this year, we would be almost at around 90% capacity utilization. In H1, maybe we will only reach to around 50 to 60%. So next year, the subsequent year, we will be running at a full out.
So this 250 crores of revenue potential you can achieve in 24 from this new plant, right?
Yes.
So my question was, this 250 crore itself of incremental revenues, unless it gets substituted by something else, on a current base should itself give you a 13-14% kind of a growth. So I was more coming that why this conservatism of those just 5, 10, 12%. I think this plant itself can give you a 14% growth. So am I looking at it a little differently, or is there some other angle to that?
Yeah. So I'll tell you two things again. I think some of you are not trying to understand the perspective. One I am saying is a value growth. I'm not talking about. I'm talking about the volume growth, not the value growth. Okay. So when I'm talking at a 5 to 7% volume growth and it is in the premium segment, then the value growth will be better. Okay. And second thing I am saying that whatever will be the industry growth, that in any case will be participating. So if the industry grows by another 4-5%, that can be additional volumes. So if my volume grows at 11-12%, the value can grow at 13 to 15% easily.
Okay, sir. That is super clear and super helpful. Thank you so much and wish you all the best. Thanks.
Thank you. The next question is from the line of Sonal Kohli from Warhead India. Please go ahead.
Thank you for giving me this opportunity. I wanted to understand from you that in the heydays of real estate, let's say 04 to 10, would you have a perspective of what growth rate was the industry growing at on a 5-year basis, on a 3-year CAGR basis?
The housing sector growth rate you are talking about?
No, your industry plywood, which is a proxy, but they may not be perfectly correlated.
Well, if you are looking at the past data, you're saying, right? Last 5 years.
No, I'm talking about the heydays of real estate, which were definitely not last 5 years. I was referring to 2004 to 2010 kind of period when real estate industry was growing, which is a generic expectation from the markets. Whether it does or not is a different matter, but people expect the cycle to be good. So I'm just trying to get a perspective. What happened in the past cycle?
No, I don't have that insight at this point of time, Sonal. But we can always get back to you, do some more homework, and come back to you for you.
Secondly, sir, one clarification. In your remarks, you have been talking about industry growth to 3, 4, 5, 6%. So one clarification here. When you talk about growth rates, considering there were one-offs, must have been one-offs in for the industry, both in Q1 and there may be some one-offs during December, January due to Omicron as well. So I wanted to get a perspective when you make the statement of 3, 4, 5, 6% growth for the industry. Are you talking on a normalized base? Because 2022 was definitely not a normal year as far as the industry is concerned.
Well, yes, I'm talking on a normalized base only. I do understand that even this year is not a very normal year. So I'm just not talking about what is my next year growth target. What I'm talking about is snatching market share from the unorganized sector by different things what we are doing at the ground level. So that is all on a normalized base. This year is still not a normalized, numbers. We had disruptions in Q1 again this year. So my next year overall number or value growth will be much higher.
Secondly, sir, considering you are more at premium and there's a, finally for us as investors, volume, frankly, doesn't matter because, you grow 30% and, your volume growth is 5%, hardly of any consequences to anyone, So I wanted to understand, considering your new capacity is coming up in premium, can you give us some perspective that, what would be your value added growth? So let's say if your volume grows by 5%, or 10%, whatever that number is, hypothetical, how much more would your value growth happen, based on what you know today?
So, if I understand your question, what I can say is that, setting up this unit in Sandila is also again strategic. We get certain advantages in terms of, our raw material costs and other costs, which helps us to get better margins, from the produce of that particular plant. So that will help us in doing a number which is, in terms of value proposition, which is better than my volume growth. I don't know whether I've been able to answer your question or not.
So, I was coming not from a strategic perspective, I was coming from a premium, because premium, pricing is way higher than, normal. So for us as investors who don't understand these kind of nitty-gritties and neither do we have access to the data, it will really help us if you can give a broad perspective. So let's say hypothetically, to make it easier, your overall growth is 10%, maybe 5% industry growth, 5%, over and over industry growth. How much would be your value growth based, would it be like 15, would it be like 12, would it be like 20?
No. So if overall volume grows by 10% on a normalized scenario, it will not happen only in the premium segment. It will also happen in the value segment. So then that 10% will result into maybe 11 or 12% growth only, not significantly higher. Because see, the company will grow in that particular mix only. We are present in the premium segment. We are present in the value segment also. We are concentrating on both the segments because there are different markets, different consumers. And we are also setting up capacities which will be able to cater the demand on both those segments also.
So you're not expecting over 2 years our mix to change in a very significant way. It could be slightly around there, but not a very big change.
No.
Understood, sir. This is pretty helpful. So if your 250 crore gets absorbed, there'll be to match this, you're expecting outside this 250 crore part to also grow accordingly, right? Have I understood you correctly?
So your voice was not very clear. Can you just repeat the question?
My apologies, sir. What I was trying to say that considering you said that by FY24 your 250 crores of new plant will get absorbed, and then you said that your product mix is not going to change very materially. So so accordingly, for your product mix to remain similar to what it is now, the non-premium part of the business will also have to grow to match this 250 additional turnover on the premium side. Is what I was asking you.
Oh, absolutely. You have really hit the nail.
Great, sir. This is, very helpful. Thank you so much.
Thank you.
Thank you. The next question is from the line of Sanjay Avatramani from Envision Capital. Please go ahead.
Good morning, and thank you for giving me this opportunity.
Good morning.
Yeah. So my question was on any further capex for the next year, or if you can give us some timeline and guidance on capex part.
Are you talking of the normal capex, the routine maintenance capex, or are you talking about this plant expansions, what we are doing?
No, plant expansions, I would be expecting something, sir.
So, our total for Sandila, most of our capex will happen within March. Okay. And for next year, we will have close to around 450 to 500 crore getting invested in the MDF facility. And other than that, we will have our normal routine capex of around 15 to 20 crores.
Okay, sir. And sir, any competitions we are facing in this premium segment, if you can name some, sir?
No, there's nothing which we can really discuss or we can point out.
Okay, okay. And previously you gave some margin guidance, which you said that we'll be able to maintain this and not go below this margin. So that will be in the range of, if you can quantify that, sir?
So this quarter we have done around 11%. If you see our adjusted core EBITDA, so I think 11% is a doable number. And as I said, the type of initiatives what we have taken with sales volume growth. Of course, one thing which everyone doesn't speaks about, I had also spoken around a year back, that we are reinvesting also a lot on the business, on our processes and systems. Despite that, we have improved on our margins in the last 12 months by almost more than 1.5%. So I'm just placing that on record. And even if you will look at our EBITDA to PBT percentage also improved, because our interest costs reduced substantially. That was another 1% advantage what we got during this period. Now, coming back to your question, 11% is the margin which we have achieved during this quarter. And my statement is that we can only improve further from here.
Okay, okay. And so last one from my end, any revenue guidance for overall FY23, if you can highlight something on that?
We're just doing our budgeting process, but if you ask me, anything less than 15% for sure is not at all acceptable. So it has to be 15% plus.
Okay, so 15% plus for FY23 from FY24, whatever we achieve in Q4 plus.
Yes, yes.
That's all from my end. Thank you so much and good luck, sir. Thank you.
Thank you.
Thank you. The next question is from the line of Arun Agarwal from Kotak Securities. Please go ahead.
Thanks for the opportunity, sir. So my first question is on the quarterly numbers, wherein can you just explain why was the profit from joint venture higher on this quarter?
Well, there is a small one-off commercial tax case where the auditors have said that we will have to take that as the income because that is a refund which is to be seen in the next 3 to 4 months. It's around 1.5 odd crores.
Okay, all right. So that's 15 million out of the 26 million there.
Yes, yes.
But now since we are ramping up capacities with the manufacturing partners, I believe that comes part of the joint venture profits, right?
No, it will not come as a joint venture. They are all like partnership firms. So whenever they will have to do this, they will do it through dividends. So that will be upstreaming of dividend because they don't fall under the definition of associate or a JV, and that's why we are using the term manufacturing partner. We have an investment in all these things, which as a company we've decided should be less than 20%, and which means it does not qualify as per the definition of the accounting standards, neither as an associate nor as a JV.
Okay, but the sales that happens from these, joint ventures or the associates, what we talk about,
yeah.
They happen first to Greenply and then it goes from Greenply books to the distributors.
Yes. So in a way, it is like trading sales for us.
Okay, it's a part of trading sales. All right.
Yes.
And so another thing is, can you share?
Sorry. That's why I think in the presentation we have started capturing that. Yes. In the presentation also we have started capturing that separately for everyone to understand what is my pure trading purchase and sales, what is my purchase and sales on account of all these manufacturing partners and my own manufacturing.
Yeah, sir, we saw that thing. Okay. So thanks. So another question is on, can you share what sort of price hikes we have taken so far this year?
We have taken almost around 8% of price increase also.
This includes the 2.5% which you've taken in fourth quarter, right?
No. That is separate.
Okay, so if we add this, it comes to more than 10% price hike, yeah?
Yes.
And then we talk about whatever volume growth numbers you have been sharing. So this taken together would look to be more than maybe 15% what you have guided for. Then even if you take 5% or 5 to 7% growth, without an industry growth, that should translate into more than 15% revenue growth for you.
Yes, as of now, yes. If you add up those numbers, it's like that. But you never know the way the volatility is there in the market. Who knows? If tomorrow the raw material prices start coming down, then we again things might be very different.
Yeah, I'm talking on the numbers as of today, sir.
Right.
All right. Okay, so that's all from my side. Thank you.
Thank you.
Thank you. We would now request participants to limit your question to one at a time. The next question is from the line of Udit from Yes Securities. Please go ahead.
Yes, thank you for my question. So just a follow-up that we are mentioning that we grow above and over 5%, and we are also talking about.
Sorry to interrupt you, Udit. Your voice is breaking up. We cannot hear you very clearly. Your voice is breaking.
We can't hear you, Udit.
Hello?
Yes, sir.
Better.
Please go ahead, and if it is not good, I'll let you know.
Yeah, sure. So I just wanted to clarify that we are talking about gaining market share from the unorganized largely. So will our growth in the trading business be more as compared to own manufacturing?
We again could not understand your later part of what you said.
He's asking that when will the trading business volume grow higher than the own manufacturing?
Well, as I said that the mix may remain almost similar over a period of time, but as new capacities get added at different point of time, you may see some swing in the mix on a quarter-to-quarter basis.
Right. And sir, largely on the demand front, now as we are seeing the prices going up, how does it impact the demand, or how are we seeing the demand for Q4 and coming year?
Well, the demand right now is good. Q3, of course, because of this Omicron, again, there were some headwinds. Again, some level of uncertainty, but we were able to sail through. The demand will remain good. There are certain level of, uncertainties. If you see the external market is extremely challenging. You see the volatility in oil prices, the volatility in all the commodities. Okay, supply chain for sure is a disruption all along. So there are a lot of external factors for sure. But I still feel that people have taken most of these things into stride and are moving forward. So the demand will remain good going forward. We don't see much challenges.
Thank you. I would request Udit to rejoin the queue for follow-up questions. The next question is from the line of Vijay Karpe from Bryanston Investment. Please go ahead.
Yes, thank you for the opportunity. Am I audible?
Yes.
Yeah, my question pertains to the new plant expansion that we are doing. What I wanted to understand is, does this new MDF plant have its own captive power plant as well? And how is the new UP Sandila plant different from our old plant in terms of modernization, new machinery, and capex requirements, inflation?
No, captive power, we are still, we are just doing some work. We are still not decided on that for the MDF plant. Of course, we will not be able to do a full tie-up, but a reasonable tie-up is possible, which we are exploring. And once we finalize, maybe we can always share with you. And in terms of the Sandila plant, own plant versus a JV plant, yes, technology-wise, we will not be much superior because in terms of plant and machinery, we only guide them. But the only thing, as you know, that when you set up your own facilities, there are additional costs. Now, in this case, for sure, when you look at a Sandila plant, we had additional investment also because there is a large chunk of land which is lying there, which will be used for future expansion. Then there has been additional licensing costs because we didn't have a license there. And our even overall office construction space and labor quarters and all those things are something which we do. So that's where, when we set up our own facilities, they become expensive compared to any of these manufacturing partners.
Okay. And what was the production numbers and sales volume for the quarter? And also, I think a few quarters back I had asked this question of why we are not setting up our own plant in the south or getting into some tie-ups, because after that one of our competitors has already announced setting up a new plant in the south.
Are you talking about plywood or are you talking about?
Plywood.
Well, okay, of course, a point taken. We are also looking at the pockets where the gaps are, and we'll definitely look at this also.
And the production and sales volume for the quarter?
Production and sales volume for the quarter. Just 1 second. It's there in the presentation, but just 1 second. Production is 8.8 million. 8.4 million, yeah. Production is 8.4 million square meter, and sales volume is 15.6.
Thank you. And last question from my side. Is there any timber availability issue for the plywood? Because what I am getting from the ground is the timber availability for MDF is there, but for plywood, which requires for filling and all, that is a little constrained.
Yes, we have seen some challenges, not purely from the availability perspective, but also from the pricing perspective. So, and that is again, I think it's a demand-supply thing only. So when the supply is lower, the prices tend to move up, and that's where the timber prices have gone up in the last 1 year. So definitely, to some extent, that is a challenge.
Got it. Thank you so much.
Okay, thanks.
Thank you. Request participants to limit your question to one at a time. The next question is from the line of Atul Lohade from JM Financial. Please go ahead.
Yeah, just a clarification. In the last call, we talked about ESOP charge of somewhere around 5 crores for FY23. But while in today's conversation, you indicated it could be 100 to 200 basis points. So if you could just clarify what is the cost we are looking at for FY23 and 24 in terms of ESOP charge?
No. So in that call, we also clarified that was the cost pertaining to the last ESOP what was being granted, and there would be further which will be granted in the month of March. So there would be costs associated with that for the coming year. Okay. So keeping that in mind, we mentioned that it's better to look at around a 1% charge plus for the next 2 years.
1% for next 2 years, right?
Yes. I think that will almost mostly absorb most of the costs.
And this is basically current ESOP plans which we have approved, and not the ones which we could potentially approve later.
No. It is out of the current ESOP scheme only. Yeah.
Okay, understood. Thank you so much.
Thank you.
Thank you. The next question is from the line of Sonal Kohli from Bowhead India. Please go ahead.
Sir, one clarification. So the EBITDA margin of 10%, you are saying 11% you said, could be your bare minimum. Is it post ESOP cost or pre ESOP cost? Because it's more or less recurring if it pays for the entire 2023 and 24.
No, so what we are talking now, referring every time is the adjusted core EBITDA margin, which is 11%.
Okay. And secondly, why would you expect your margins to be 11% considering, you have done a price hike and I presume the Q3, or have you seen costs further go up in Q4, compared to Q3 and therefore it's 5?
Yeah. So that's what I mentioned, that, in around December, we felt that the prices are slightly subdued or coming down, but in January again we saw it went up significantly. So, so whatever was the lag, we felt that we take this price increase and it will cover more than adequately. And then we see another round of increase now. If that increase is sustained increase on the cost side, then we might have to again either look at a price increase in maybe Q1, or it affects my margin to some extent, which we might have to absorb.
So, sir, when you're talking about level,
that's why I said that 11% seems to be, a base level, because we'll have operating leverage to some extent. We have these volatilities, and we have been passing on this price increase. I mean, the entire industry has been passing on. Okay. So, keeping all these things in mind, I think 11% is a number which is a base number.
So it is not the minimum number, it is your base number, right?
Yes.
Okay. Secondly, sir, you mentioned about a 15% revenue growth next year. Again, for the sake of clarity for all participants, are you referring to your normal base, because the Q1 revenues are pretty low? So if I make your Q1 revenues to be normal, it next year, it itself will, your business will grow by 12%. So are you looking at only 3% extra growth next year, or you're talking from your normal base, you're expecting a 15% growth next year?
No. Right now, I just said we just started our budgeting process. Okay. And as you have done some maths, I've also done some maths, and that gives us that comfort that maybe 7 to 8% for sure is the increase because of the disruption of 1 month, and that's why I said that 15% plus is for sure is the number which will come up.
Thank you. I would request Mr. Kohli to rejoin the queue for follow-up questions. The next question is from the line of Rishabh Bothra from Anand Rathi. Please go ahead.
Yes, I just wanted to understand, based on the production numbers slide, the capacity turns out to be 26 million square meters, while on the manufacturing excellence, it's 34.9 million square meters because of the reassessment. So there is still rooms for scope for enhancement of utilization levels, correct?
Yes, to some extent, yes, in certain pockets.
Yeah, and overall capacity will increase to 58.4 million square meter once all expansion are done.
Yes.
So just wanted to understand the need for JV partners. I mean, what sort of incremental value do they add in our manufacturing process? And what kind of, you mentioned that the plant is readily available, but since the current JV which we are doing, the plant will be set up afresh, right? So what's the need for them? And secondly, what's the raw material sourcing need for us, and where are we sourcing from? Can we backward integrate, acquire forest or something of that sort?
No, so when you are talking of the need of the JVs, let me put it so, this Hapur, JV, or actually I would use the term manufacturing partner, which we have gone into, is in a way a model which is creating a capacity as well as substituting my existing trade, what I am doing. So this facility we have created mainly for our, the value brand Ecotech, which right now we have been buying totally, which was totally a trading model. So we are moving slightly away from the pure trading model to this manufacturing partner model, which gives us much larger comfort in terms of, the delivery and quality and performance, everything. Now, at the same point of time, if we are able to, in the short run, we see better traction, then of course we have the trading capacities also being there. But we would like to move to some extent to these manufacturing partner concepts for the value brands also going forward. Because the ROE is better, and our comfort, what we have seen in terms of quality, in terms of delivery, in terms of logistics is always better. Raw material sourcing, it's mainly from the north, the Yamunanagar belt itself, or the UP belt. So it's mainly from there only. Okay. Otherwise, if you see my other pockets, like for east, we have a plant near Calcutta, so we do most of the sourcing in and around, and we still get some material maybe which travels from UP. For Rajkot, again, we have Gandhidham and UP. And over and above this, of course, for Nagaland, we have our own sustained, forest there. Other than this, we are concentrating on the plantation side, and we are continuously working on that in adding those, acreage also. So over a period of time, that will be another comfort which we will draw through our own forestation, agri-forestation.
And lastly, sir, in the JV, what's the scope for enhancing the stake in the terms of agreement? And are these exclusive JV? I mean, the product are sold to Greenply only, or they can sell to other entities as well?
No, so the model remains very clear that we are not looking at increasing our stake. We don't even think that way, because we want the other partner also to come with that exuberance that over a period of time he can make money. He gets the assurance that there is a short sale, and we get the assurance that it is an exclusive facility which works fully and solely for us. So we can always maintain our quality and performance and everything. We can take our systems to their doorsteps. So for them, it's learning. For them, it's the peace of mind that they don't need to go to the market. For us, it's exclusivity, and for us, it's better quality, better performance, and implementation of our systems and processes at their place also.
And lastly, if you could split the revenue into your premium category and mass category, Q on Q as well as YOY.
I don't have it right now. Premium and mass. Just 1 second, please. On a 9-month basis?
Yeah, you can provide 9 month, but comparable as well.
सेकेंड इसमें नहीं है ना, इसे ग्रोथ दिखा रहा है 62 out of 346.
You can provide offline as well, not an issue. And another last one, in our market dominance area, who is the next competitor?
Century for sure.
Okay. And where we are positioned as second? And who is the first one? Again, Century?
Well, look, I think it's a close number 1, number 2 game. I think right now they are slightly ahead of us.
Why I'm asking this is, are we cutting down on prices to gain market share or giving this discount and rebates to our distributor and dealers? So that's
no, we don't have that mindset, And I said that I don't know about the competitor, but if you would have heard me, I am maintaining that we want to gain market share from the unorganized market, because that market segment is huge, humongous. Okay. So there is no need to do this undercut and gain shares in the short run. Doesn't help.
Okay. I'll come back in the queue, sir. Thanks for answering my queries.
Thank you.
Thank you. The next question is from the line of Nikhil Agarwal from BT Capital. Please go ahead.
Yeah, good afternoon, sir. Thank you for the opportunity. I needed some clarity on the trading, on your manufacturing and trading and this partner thing. Like the 15.6 SQM sales that you have shown, does that include the trading sales as well?
Nikhil, what I'll do now, I'll ask Gautam maybe. He'll have an offline call with you and he can, explain to you.
Okay, sir. No issues.
Of course, 15.6 includes, but if you want to understand slightly larger detail, he can explain to you.
Okay, sir. So just a couple of more questions. Like, could you just tell me the stake in JV that you have, the JVs that you have?
Take
your stake in the joint venture.
As I said, they are all less than 20%. So we try to limit it to 19%. I don't remember the exact numbers, but most of it would be around 19% type.
Okay. And so what was your EBITDA margin in the plywood business?
11%.
Okay. This includes all the three categories inclusive.
3 categories means?
Your own manufacturing partners and trading.
Yes. Yeah, it's a blended margin. Yes.
Okay. So if I may just ask you one question more. Could you just tell me the combined capacity of your own your trading and manufacturing? Is it 10 SQM, 10 SQM? That includes only your manufacturing partners, the JV. That does not include the trading.
If you look at slide number 13, I think it amply clarifies most of the queries what you are raising. Slide number 13 of the presentation, if you once look at it, and then possibly if you have any confusion, you can still speak to Gautam, or Gautam can raise to you.
Okay, sir. Thank you. That's it from me.
Thank you.
Thank you. We'll take one last question, which is from the line of Dhiral Shah from Phillip Capital. Please go ahead.
Yeah, good afternoon, sir, and thanks for the opportunity. So my question is pertaining to the greenfield capex of Sandila. Generally we have seen that in plywood, the asset turnover, is around 3 to 4 times. But in our case, it is something around 2 to 2.2 times. So why such a low, asset turnover?
No. I clarified this. Let me again clarify that, there is first a land cost, okay, which is for my overall piece of land. Since it is a new subsidiary, we had to transfer the entire land as per the UP government agreement what we had signed. So it is sitting there, but it is not getting utilized. Only 1/3 of that land is getting utilized. That itself is around 30 crore plus. And then we have licensing and our own factory building where we are even doing labor quarters, and we have done. So that is another, if you see, around 15 to 20 crores of extra cost which is there. So if you take out that 50-60 crores, my machinery cost will be only to the level of 50 to 55 crores.
Okay.
On that, if you will see, we will be actually, around 4 times, 4.5 times, or even more.
Okay, sure. Got your point. And so lastly, as you said that maybe, we will be outperforming 5 to 7% volume growth. So this will be over a longer period of time we are talking about, maybe sustainably over next 3 to 4 years?
Yes. That's what we are eyeing at in terms of improving our market share, and that should be over and above whatever is the industry growth. That is how we look at it.
Okay, sure. Okay. Thank you so much, sir.
Okay, thanks.
Thank you. As there are no further questions from the participants, I now hand the conference over to Mr. Karan Bhatelia for closing comments.
Hi, sir. One question from my end. Sir, while we are preparing for a greenfield capex in Lucknow, and in the last 2 years we've signed the third manufacturing partner. So what is the thought process, when you decide whether to go ahead with the greenfield or to tie up with the manufacturing partners or to purely rely on the trading model?
Always a debatable point, Karan, but how we look at it is once we had gone for those initial 2 manufacturing partners, we also mentioned that if given a chance, that is the way we want to look at, in the plywood business to improve our ROE over a period of time. But we wanted the model also to stabilize slightly. We also wanted to see what goes right, what goes wrong in an arrangement like that, so that we have a certain level of learnings which we can apply before we look at more such arrangements. But in the meanwhile, looking at the type of demand possibility which we were looking at, and even on the cost side, we felt that we already have a chunk of land which is in the heart of raw material, and that gives us an advantage of setting up the plant and saving on the margin front. So we should not sit idle, and we should set up one plant so that when we have demands and growth, we should not get stuck on the supply side. So we done that. And now again, as I said, we had certain learnings. We are using those learnings now again and concentrating to develop a few more, these manufacturing partner arrangements. And this particular case, Hapur, what we have done is purely right now from the mindset of strengthening our value segment, which is Ecotech, so which was totally on an outsourced model. And this facility will really step it up in terms of, quality, productivity, performance, everything. So that was the idea behind this.
Right. Also, it is correct to assume that over plain vanilla trading model, those vendor base are finding it difficult to operate. Now that we are done with COVID first wave, second wave, third wave, and many of them have taken a shutdown. Correct to assume that as well?
You are talking about the overall environment?
Overall plain vanilla, trading model, because many plywood branded players, had many outsourcing partners as well, which worked on a pure trading model.
Yeah.
So correct to assume that few of those have taken a shutdown, because of a challenging macro environment on the supply side and on the raw material sourcing as well?
Yes.
Okay, got it. Any further questions, operator?
No, so we don't have anyone now.
Yes. So with this, we conclude the call. Any closing remark you want to make, management team?
Yes. Thank you all for taking the time to participate in this call. In case of any further clarifications or queries, please feel free to reach to Mr. Gautam Jain. Thanks again and goodbye.
Thank you. On behalf of Asian Market Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your line.